In this lesson, we'll discuss the essential loan products for commercial mortgage brokers. The goal of this lesson is to provide a thorough understanding of the best loan products for investors, focusing on how to select the right options for clients. You'll learn about loan specifics, including ideal use cases, eligibility requirements, and typical terms. Now let's dive into the three essential loan products: bridge loans, DSCR or long term loans, and small multifamily loans. Bridge loans are short term commercial mortgages used when traditional financing may not be an option. They are flexible, allowing for quick closings and funding through an LLC. They're also known as commercial hard money. Why are we here? Because we solve a problem. These loans are for deals that are not bankable. My book, Financing the Unbankable Deal, was written for this market. When investors cannot turn to their normal sources of capital, they'll turn to you. Master these loans. It'll make you a lot of money. Now let's talk about them in depth. Let's do a deep dive. Commercial bridge and hard money loans generally cover loan amounts from $250,000 up to $25 million. When it comes to property types, almost every property type can be covered, whether it be multifamily, office, industrial, warehouse, all the main major food groups, as I like to say. When we talk about ideal use cases with this type of loan, property acquisitions, especially when it involves quick purchase opportunities, cash out refinances, rehabs, especially if it involves lease up and stabilization, matured or defaulted loans also count, and partner buyouts. When you think about documentation, having a clear exit strategy is required. We need to inform the bridge lender who's doing the temporary loan what's the plan? Refinance, selling the property, how are they going to get paid off? Other documentation, appraisal, clear title, and insurance. There's no tax returns. Depending on the situation, you may not even need a rent roll or operating statements. Generally, they will look for bank statements to prove liquidity to close. So if we know we need 300,000 or half a million to close, they want to make sure you get at least that much in cash. Let's talk about terms. 6 to 24 month terms, up to 36 is possible. Typical is going to be 12 months, maybe 24. You look at the higher interest rates, 8 to 15%, and a lower loan to value ratio, 65 to 75% is going to be typical, but more on the lower side, 65 to 70. You're looking at interest only. And as far as our funding is concerned, 1 to 2 week funding time after we get the appraisal back. Let's look at costs. You're going to have higher closing costs with these types of loans. Your origination fees are going to be from 2 to 4% or higher. You're going to have a lower due diligence expenses, however, because for the most part, you're just getting an appraisal. There's a whole nother level of due diligence that you're getting on the traditional side that's not required when you're doing bridge or hard money. Prepayment penalties may apply, but generally not so. In summary, these loans are for investors needing fast, flexible financing who may not qualify for traditional bank loans, or it does qualify, but we need quicker execution than a conventional lender can offer. Fix and flip loans are short term financing for purchasing, renovating, and reselling of residential investment in small multifamily properties, 20 units or less. Key features of these type of loans is when purchasing a deal, borrowers will usually get up to 90% of the purchase price and 100% of the rehab costs financed by us, depending on their FICO and their experience. Let's do a deep dive into these loans for single family residential and multifamily investors. Loan amounts. You're going to be looking at 100,000 to 5 million for single family residential, 300,000 to 50 million for multifamily. Let's talk terms. 6, 12, 18-month, 24-month terms are common. The most typical is going to be 12-month terms, 9 to 15% interest, and it's going to be interest-only payments. Ideal use cases: acquisitions with or without a rehab, buy the rent, cash out refinances, and fix the rent. Let's talk documentation. There is no tax returns or W 2s. We just need a detailed scope of work with renovation budget, a detailed real estate investment track record. Usually we get the schedule of real estate owned so we can see all of their investment experience, and a credit report, ideally set 620 or higher, and bank statements to verify liquidity prior to closing. Timing wise, we want to close generally, we can close 7 to 10 days after the appraisal comes back, sometimes faster. Lenders going to evaluate these deals based on four primary criteria. One, what's the value of the property as is and the after repaired value, the AIV and the ARV. Two, the feasibility of the renovation budget. Three, the borrower's flipping experience. So if they're doing a deal, let's say it's got a $100,000 rehab budget, how many similar projects in that market have they completed? The better the experience, the lower the liquidity requirements are, the better the interest rate, so on and so forth. And then lastly, they're going to look at the market and sales data in that area. They want to make sure that there's a robust sales market. So if they're flipping the property, there's enough sales there to support it where it makes sense. What this also means is if a property is rural, it's probably not going to get financing. Rental property is another $1 trillion market that is not going anywhere. DSCR stands for Debt Service Coverage Ratio. It's a measure of cash flow over payments. Short version is these loans are based on the rents covering the expenses of a rental property, not personal income. Best used to refinance out of a fix and flip loan or to purchase rental property as part of a long-term buy and hold strategy. Let's discuss in depth. Let's do a deep dive into these long-term loans for single-family residential and multifamily investors. When it comes to loan amounts, 100,000 to 2 million is the range for single-family residential and 300,000 to 100 million plus for multifamily. When it comes to terms, you're looking at 30-year fixed rate, fully amortized loans for single-family residential and 10-year fixed rate for multifamily. Interest rates are going to start around 6.25%. Of course, this is going to vary based on market conditions. You're going to finance up to 80% of purchases and 75% LTV for cash out refis. Ideal use cases. Ideal use cases for this kind of loan is going to be obviously buy to rent, refinance to rent, cash out, and rate and term refinances. One thing, there cannot be any rehab. So there's no rehab or construction allowed or must be required. When the appraisal is done, if there's any that must be done above more than like $2,000-3,000, it'll be disqualified from this type of financing. Short-term vacation rentals like Vrbo and Airbnb are also allowed. When it comes to documentation, we need copies of leases, the real estate investment experience track record, which we'll document with the schedule of real estate owned of the borrower. You'll need a credit report. Obviously, we're looking for 680 and above for single family residential, 700 for multifamily. And we want bank statements, usually 3 months, because we want to verify liquidity, that they have enough liquidity to close, plus usually 3 to maybe 6 months of expenses. From a timing perspective, we're going to close within 15 days of the appraisal coming back. So typically from application to closing is about 30 days for single family and 60 days for multifamily. Lenders are going to evaluate these loans based on four criteria: property value, as is value of the deal, the market rent data. So they want to know what's the market rents versus actual, and the borrower's property management experience. That will also be key as to rate, terms, and other conditions. All the terms and conditions we've discussed in this lesson are typical of competitive programs in the marketplace. Below, use the resource link to download my loan program sheet. For our members who do not yet have their own lender relationships, remember you can partner with me to get your deals done until you have fully established your own brokerage firm. In the next lesson, we're covering case studies.